August 8, 2025. The day began like any other until a single news alert changed everything. Gold, already strong amid economic anxiety, suddenly became the epicenter of panic. The alert: the US was rumored to be imposing tariffs on imported gold bars, a move that would upend the bullion trade. Markets reacted instantly. Gold prices soared, smashing records within minutes as traders scrambled to buy. Digital tickers blurred green, futures contracts hit unprecedented volumes. The rumor tapped into deep market fears, transforming a policy whisper into a stampede for safety. This wasn't a rally built on data, it was pure, unfiltered fear. The idea of the US taxing gold sent a chilling message, threatening to disrupt the global supply chain. By midday, gold had soared past $2,800 an ounce, marking one of the most dramatic single-day gains in history. The world watched as a whisper became a roar, pushing gold into uncharted territory. The source? An anonymously sourced report on a minor financial newswire claiming the White House was preparing tariffs on gold from non-allied nations. The rationale: counter-currency manipulation and protect U.S. refining. Thinly sourced but plausible enough to terrify in a tense geopolitical climate. High-frequency trading algorithms reacted in microseconds, triggering a cascade of buy orders. Human traders followed, fearing they'd miss out, fueling a self-fulfilling surge. Physical gold dealers worldwide saw websites crash, and phones ring off the hook as panic buying set in. The story's power was in its ability to combine the market's biggest anxieties into a single, potent threat, proving how fragile sentiment had become. As gold soared, silence from Washington only stoked the fire. The absence of denial was seen as confirmation, and panic spread. Pressure mounted on the White House to respond as global markets teetered. Finally, the press secretary appeared. The reports of gold tariffs are completely false. There are no such plans. Regulators launched an investigation into the rumor's source, signaling zero tolerance for market manipulation. The market's reversal was immediate. Gold prices plunged as quickly as they'd risen. Algorithms that bought now sold, and panic turned to regret. Gold settled well above its opening price, leaving a scar on market psychology. The day exposed just how much anxiety simmered beneath the surface. The flames were out, but the smoke of uncertainty lingered. Why did a tariff rumor cause such panic? Look to Switzerland, the world's gold refining hub. Two-thirds of global gold passes through Swiss refineries, which produce the trusted bars used by banks and investors everywhere. A US tariff would disrupt this flow, creating a two-tiered market and spiking prices for trusted bars in America. Investors would face premiums or turn to less reputable domestic refiners. The gold market thrives on standardization and trust. A tariff would shatter both. Geopolitically, targeting Swiss gold would penalize countries worldwide that rely on these refineries. Nations in Africa, South America, and Asia would be forced to seek alternatives, risking revenue and ethical sourcing. The result? A bottleneck in the global supply chain and a blow to the integrity of the gold market. Trust, once broken, is hard to restore. Gold's journey is global and complex, mined in places like Nevada or Ghana, then shipped as semi-pure door bars to refineries, mostly in Switzerland. There, it's purified and cast into investment-grade bars, the backbone of the global gold market. These bars back financial products and sit in vaults from London to New York. Any disruption, like a tariff, threatens the integrity of these instruments. The rumor threatened to sever the link between Swiss gold and US markets, risking scarcity and chaos. If a New York bar costs more than a London bar, gold ceases to be a universal commodity. This fragmentation undermines gold's role as a global store of value. The result? Arbitrage, confusion, and a market no one can trust. The tariff rumor was just the spark. Gold was already primed to explode. Inflation fears had been driving prices up all year, as central banks struggled to contain rising costs. Investors flocked to gold to protect their purchasing power, creating a high price floor. Central banks signaled rate cuts, making gold more attractive as yields fell. Geopolitical tensions and ongoing conflicts fueled further demand, as did official sector buying by governments seeking to diversify away from the dollar. Economic malaise and recession fears pushed investors toward defensive assets. Manufacturing slumped, earnings forecasts fell, and uncertainty reigned. Gold was already shining as the ultimate safe haven. The market was primed for a surge. The tariff rumor simply unleashed the energy. In this perfect storm, gold's spike was inevitable. The August 2025 spike instantly joined the ranks of legendary gold booms. Like the surges of 1980 and 2011, it was driven by fear, uncertainty, and a loss of faith in financial systems. In 1980, oil crises and inflation sent gold soaring. In 2011, debt crises and credit downgrades did the same. The 2025 event mirrored these themes but unfolded at lightning speed, fueled by digital rumors and high-frequency trading. Unlike past booms, this was a flash panic, an explosion triggered by a single headline. It showed how, in today's hyper-connected world, market panic can be manufactured and spread in minutes. The underlying fears were familiar, but the delivery was pure 21st century. Information and misinformation now moves at the speed of light. The vulnerability of global finance has never been clearer. The wild ride of August 8, 2025 is a stark reminder of gold's enduring power. More than a commodity, gold is a symbol, a mirror reflecting our deepest anxieties. In calm times, it's a hedge. In crisis, it's a barometer of fear. The tariff rumor was a stress test, revealing just how fragile trust had become. Gold's price is most volatile when the world feels least stable. Investors turn to it not just for value but for reassurance when institutions seem shaky. The event underscored the importance of trust in the financial system, trust in purity, security, and the rules of trade. The rumor struck at this trust, and even a swift denial couldn't erase the doubt. Gold will always be the asset of last resort, its price a fever chart of global health. As long as uncertainty persists, gold will remain our silent sentinel, warning us when faith in the system falters.